There's a pattern in history that has confiscated private wealth from citizens 3 times in the last 2,000 years. And right now, in 2025, the United States is following that exact same pattern, stage by stage, policy decision by policy decision. The US has already completed 2 of the 4 stages that led to confiscation every single time before. In 301 AD, Rome debased its currency from 95% silver to 5%. Citizens lost their wealth through inflation they couldn't escape. In 1931, Britain abandoned the gold standard entirely. The pound devalued 25% overnight. Savers holding sterling lost a quarter of their purchasing power. In 1933, the United States made gold ownership a federal crime. Executive Order 6102 gave Americans 25 days to surrender their gold at $20.67 per ounce, or face 10 years in prison. 9 months later, the government revalued that same gold to $35 per ounce. 3 times. 3 governments. 3 confiscations of private wealth to escape debt they couldn't pay. And here's the data point nobody wants to talk about. In 1933, U.S. debt was 40% of GDP when they confiscated gold. Today, it's 123%. We're paying $1.1 trillion annually just in interest, more than we spend on defense. The experts will tell you this could never happen again. Gold ownership is legal now. We're not on the gold standard. The economy is different. But in February 1933, Treasury Secretary William Wooden told Franklin Roosevelt something that changed everything. We cannot inflate our way out while citizens can demand gold. 32 days later, gold ownership became a crime. That same mathematical constraint exists today, and the pattern says what comes next. Let me walk you through the 4-stage sequence that has preceded every major government seizure of private wealth in the past 2,000 years. This isn't theory. It's documented pattern across 3 separate confiscation events, and understanding these stages will show you exactly where we are right now. Stage 1 is unsustainable debt accumulation. This is the point where government obligations exceed revenue capacity at current currency values. In 1929, federal debt stood at $16 billion. By 1933, it had climbed to $22.5 billion, a 40% increase while GDP collapsed 46%. The government owed more than it could pay unless it changed the rules. That's the debt trap. Revenue falls while obligations stay fixed, and the gap becomes unbridgeable without intervention. Stage 2 is loss of monetary confidence. This shows up as bank runs, hoarding, and capital flight. Between 1930 and 1933, 9,000 banks failed. In February 1933 alone, $140 million in gold left the United States. Prices fell 25% during this period. That's deflation, and when paper currency loses credibility, people demand real money. They demand gold. The mechanism is simple. Citizens stop trusting promises and start holding assets the government can't print. Stage 3 is a government constraint. The government cannot print its way out and cannot devalue its currency, while citizens hold the real asset and can demand redemption. In 1933, the U.S. was legally obligated to redeem paper dollars at $20.67 per ounce of gold. Treasury reserves were under severe pressure. The gold standard became handcuffs. You can't devalue if citizens can walk into a bank and demand gold at the old rate. Every dollar of gold in private hands is a dollar that blocks the government's exit from the debt trap. Stage 4 is confiscation followed by devaluation. The government removes private claims to hard assets, then revalues the currency downward. April 5, 1933. Executive Order 6102 forced confiscation at $20.67 per ounce. January 30, 1934. The official price was set at $35 per ounce. That's a 69% devaluation of the dollar against gold. Anyone who surrendered at the old rate lost 41% of their purchasing power overnight. Here's where we are now. U.S. debt stands at $36 trillion as of 2024. Debt to GDP ratio is 123%. We're going to walk through how this happened before, and then I'm going to show you where we are now. The United States entered the 1920s as a net creditor nation after World War I. Federal spending held relatively steady, 3.1 billion in 1920, 3.3 billion by 1929. The system looked manageable until October 1929, when the stock market crashed. Unemployment went from 3% to 25% by 1933. GDP collapsed from 103.6 billion to 56.4 billion, a 46% contraction. Tax revenue cratered while government obligations remained fixed. Here's where the deflationary spiral began. The dollar was pegged by law at $20.67 per troy ounce of gold. As prices fell 25% across the economy, the real value of debt increased 33%. Every dollar owed became more expensive to repay in deflation. Banks faced runs as depositors demanded gold, and banks couldn't comply because their assets were tied up in failed loans and worthless securities. In February 1933 alone, $140 million in gold fled the country. By March 3rd, Treasury gold reserves stood at $4 billion, the lowest level since World War I. Every dollar someone hoarded in gold was a dollar the government couldn't use to fight the Depression. Franklin Roosevelt was inaugurated March 4, 1933. 5 days later, his Treasury Secretary William Wooden pushed through the Emergency Banking Act, giving the president control over gold transactions. Wooden was a former railroad industrialist, and he told Roosevelt directly, "We cannot inflate our way out while citizens can demand gold at $20.67. That constraint was the trap. The government needed a cheaper dollar to reduce the real burden of debt, but it couldn't devalue while citizens held claims to gold at the old price. 32 days after inauguration, Roosevelt signed Executive Order 6102 on April 5, 1933. The text was explicit. All persons are required to deliver on or before May 1, 1933, all gold coin, gold bullion, and gold certificates now owned by them. Exceptions were narrow: $100 in coins, jewelry, rare coins, industrial use. The penalty was $10,000 in fines, which is $230,000 in 2024 dollars, and 10 years in prison. Americans had 25 days to comply. They surrendered 300 tons of gold to Federal Reserve banks. Then came the transfer. The Gold Reserve Act passed January 30, 1934, and reset the official price to $35 per ounce. If you surrendered 100 ounces in April 1933, you received $2,067. 9 months later, that same gold was worth $3,500. You lost $1,433, a 41% haircut. This wasn't theft, it was arithmetic. The debt load required a cheaper dollar, but they couldn't make the dollar cheaper while you held gold. This same sequence appears throughout history when governments face debt they can't pay. Rome provides the clearest ancient parallel. Emperor Nero reduced silver content in the denarius from 95% to 90% between 54 and 68 AD. That was just the beginning. By the time Septimius Severus ruled from 193 to 211 AD, silver content had fallen to 50%. Under Diocletian, who ruled from 284 to 305 AD, it dropped to 5%. This was confiscation through currency debasement, the same 4 stages playing out over 240 years. Debt from military campaigns created pressure. Pressure forced a confidence crisis as citizens recognized debasement. The crisis depleted government silver reserves. Depletion made further debasement inevitable. Diocletian tried to stop the spiral with the Edict on Maximum Prices in 301 AD, imposing price controls to combat inflation. It failed within years because the underlying problem, unpayable debt requiring currency, destruction, remained unsolved. Britain followed the identical pattern in 1931. On September 21st, Britain abandoned the gold standard entirely. The context was World War I debt, global depression, and gold reserves under attack from capital flight. The pound devalued 25% immediately. Britain didn't formally confiscate gold because they went off the gold standard completely, but the mechanism was identical. Debt trap, confidence crisis, reserve depletion, devaluation. British savers holding pounds lost a quarter of their wealth overnight. The pattern mechanism works like this. Stage 1 debt accumulation creates fiscal pressure. That pressure forces Stage 2 confidence crisis as citizens recognize the trap, bank runs, and hoarding follow. Hoarding depletes Stage 3 government reserves of the hard asset backing the currency. Reserve depletion makes Stage 4 confiscation or debasement inevitable because the government cannot inflate away debt if citizens hold inflation-proof assets. They must remove citizens' claims first. Now look at 2024 numbers. U.S. debt stands at $36 trillion. Debt to GDP is 123% compared to 40% in 1933, before confiscation occurred. We're paying $1.1 trillion annually just in interest, more than the entire defense budget. Treasury holds 8,133 tons of gold. At $2,000 per ounce, that's $523 billion in value. Gold reserves cover 1.45% of total debt. In 1933, U.S. debt was 40% of GDP, and they confiscated gold. Today, it's 123%. The pattern hasn't changed, only the numbers got bigger. Stage 1 is complete. Federal debt stands at $36 trillion as of 2024. Debt to GDP ratio is 123%, the highest since World War II. Compare that to 1933 when it was 40%, or the 1945 peak of 119%. The annual deficit runs $1.7 trillion as of 2023. Interest costs alone hit $1.1 trillion, consuming 23% of all federal revenue. We're paying more in interest than we spend on defense, Medicare, or anything except Social Security. The Congressional Budget Office projects debt will reach 180% of GDP by 2053 under current policy. This is unsustainable debt accumulation, and it's measurable. Stage 2 is in progress. You won't see this as bank runs in the streets, but it's visible in monetary behavior. M2 money supply stands at $21.2 trillion. The Federal Reserve balance sheet expanded to $7.7 trillion from $4.2 trillion in 2020. Private gold purchases are accelerating. The U.S. Mint sold 1.45 million gold eagle coins in 2023, the highest level since 2010. Global central bank gold purchases hit 1,037 tons in 2022, the second highest on record. Gold reached $2,400 per ounce in May 2024, an all-time high. When central banks buy gold aggressively, they're expressing doubt about fiat currency. This is loss of confidence showing up in asset allocation, not depositor panic. Stage 3 is partially complete. The U.S. isn't on a gold standard, which is the key difference from 1933. But the dollar remains the global reserve currency, and that creates a different constraint. Treasury holds 8,133 tons of gold, unchanged since 1973. At $2,000 per ounce, that value's at $523 billion. The constraint today is this. The government can't devalue freely without losing reserve currency status. Foreign entities hold $7.6 trillion as of 2024. If the dollar crashes, the global monetary system destabilizes. That's the new handcuff, not gold redemption, but reserve currency dependence. Stage 4 hasn't happened yet, but the pattern shows what would trigger it. A dollar crisis requiring restoration of hard asset backing. A debt spiral forcing monetary reset. Central bank digital currency implementation requiring gold backing. A financial system reset similar to Bretton Woods in 1944. The mechanism today wouldn't target physical gold coins because few exist. It would target gold ETFs. Funds like GLD hold over 1,000 tons. Gold IRAs and retirement accounts. Digital gold holdings. Mining company shares. The legal pathway already exists. The Emergency Economic Powers Act from 1977 gives the president authority over gold transactions. Executive Order 6102 was never formally overturned, only made irrelevant when gold ownership was relegalized in 1974. An executive order with a 25-day window, just like 1933. We're 3 stages deep into a 4-stage pattern. The numbers are worse than 1933. The only question is what triggers stage 4. 1933 wasn't a conspiracy. It was arithmetic. When debt exceeds the government's ability to pay at current rates, three options exist: default, which is political suicide; hyperinflation, which is economic suicide; or confiscation plus devaluation, which is a controlled transfer. Governments consistently choose option 3 because it keeps the system running, even if it punishes savers. Frederick Campbell was a New York attorney who refused to surrender 27 ounces of gold coins in 1933. He argued Executive Order 6102 violated the Fifth Amendment's takings clause and exceeded presidential authority. His rationale was constitutional. Gold was private property. Confiscation without compensation was illegal, and he would fight the order in court to establish precedent. He was prosecuted by the U.S. Attorney's Office, convicted in district court in 1934, and his appeal to the Supreme Court was denied in 1935. The court ruled 9-0 that emergency powers during economic crisis permitted gold confiscation. Campbell paid his fine, surrendered his gold at $20.67 per ounce, while the government valued it at $35, and returned to private law practice. His constitutional challenge served only as warning to others. Compliance was not optional. The compliance rate exceeded 99% because the threat of 10 years in prison was effective. What 1933 teaches about government capability is this: they can legislate confiscation with less than 25 days' notice. They can criminalize noncompliance. They can track ownership through regulated channels, banks, ETFs, retirement accounts. What 1933 teaches about exemptions: rare coins received exemptions based on numismatic value, small holdings under $100, jewelry, and industrial use. The modern implications are clear. Physical gold is harder to track than ETFs or IRAs. International holdings outside U.S. jurisdiction face different enforcement. Tangible assets with utility like farmland or equipment are exempt from monetary confiscation because they're not currency substitutes. The pattern says we're in stage 3. History says stage 4 follows when government exhausts other options. Current trajectory is unsustainable without monetary reset, but timing is unknown. 1933 was preceded by 10 years of building pressure, 1920s debt accumulation plus 4 years of depression. Watch for stage 2 escalation, bank stress, currency flight, gold price acceleration. Understand stage 3 completion, a dollar crisis or reserve currency challenge. Recognize stage 4 triggers, emergency economic legislation, banking holidays, capital controls. The historical pattern shows government announces confiscation when devaluation is already decided. In 1933, Americans had 25 days to surrender their gold. Most did. 9 months later, they watched that gold revalued 69% higher in government hands. The pattern doesn't predict when. It just shows what comes next. The answers aren't in the future, they're written in the past.